Hey everyone, this is Kirk here again at optionalpha.com. Thanks so much for checking out tonight's video tutorial covering all of the trade alerts that we made here on Thursday, September 18th. And as always, if you guys have any comments or questions, I know I say this at the end of the videos, but I like to get it in at the beginning of the videos. I'm going to try to do that a little bit more. But if you guys have any comments or questions about the trades that we make here, so the trades that we make as part of the membership program at Option Alpha, please go ahead and add them in the comment section, either on YouTube right below this video or definitely in the members area, because that's where everyone else, can kind of chime in and see some of the other questions that everyone has. So tonight we're going to go over our one opening trade in Tesla that we made, and then pretty much a slew of closing trades, which is important because some of you who are new and saying, I don't really care about the closing trades, but it's important that we actually cover these, even though if you don't have these trades, because I know a lot of people signed up this week and they were asking, should I get into these closing trades? And obviously no, because we're getting out of these trades, right? They're not new trades that we're entering. But it is important to know why we close some of these. So I want to go over that here tonight. But first, let's talk about Tesla. Let's look at Tesla. Tesla is one of those ones that I really wanted to trade and just have kind of been waiting for an opportunity to trade. And I think that we got a pretty good opportunity, or at least as good of an opportunity as we could get with Tesla today to trade Tesla to the downside. And I'm a little bearish on Tesla, not that it won't go higher in the future. But right now, I just think that it's had a pretty rough time, and I think it's setting up for a nice little reversal from the breakout move that it's had before. And so I'll show you the chart of that here in a second. Now, logistically, what we did is we did this with a debit put spread, so a bearish debit put spread on Tesla. We went out to October, obviously, because September expires tomorrow, and we did the 270, 265 debit put spread. Paid a little over mid price, but that's okay because as you'll see here, our break even on this is really, really good. It's actually a lot higher than where Tesla ended up trading today. So the reason that we did the 270 and the 265 was because we got a break even price that was higher than the actual stock price. It gave us a little bit of room to move or for the market to move against us and still make a profit. So if we go to a chart here of Tesla, you can see that this is what Tesla looks like right now, just over the last couple of days. Had a really, really good breakout move here in the beginning of the week. And now what I think is going to happen is it's going to just, kind of run up here just a little bit, maybe even go a little bit higher, but then start to move down, right? That's what usually happens with these breakouts is they try to retest that area, but that breakout's really kind of your sell signal, and you're just waiting for maybe a little bit better pricing to get into it. So if you wanted to, you could wait another day or so, but we don't know when it's going to make its move. It definitely has rallied off of the bottom, but I definitely think it's going to continue lower. Now, if you want to look at technicals and start to use some technicals when you do these, and I'll just throw up these studies right here that I have, then two things you'll notice with Tesla is that we did have a bearish signal on CCI back when it had this huge down day, and then MACD also gave us a bearish signal on that same day. So now they're both trending lower. They both gave us pretty good signals, and you can see that the buy signals in Tesla back at the end of July, beginning of August, were actually pretty good signals, right? If you bought Tesla during that period, you would have had a nice run-up of about $60 in the stock, right? These were the nice buy signals in Tesla. So if we want to follow those buy signals, if we want to be true to at least kind of using some of these signals in our favor, not to say that they are the end-all result, as many of you know, these are not the end-all result, but they do help kind of give us some possible direction as to where the stock might go. So that was definitely part of the consideration today for getting into Tesla. Now, when we actually go to the risk profile tab, and you can see our debit put spread here, what you'll notice is that Tesla is trading right here at about 263.82. And because of the great pricing that was in the options today, that actually got our break-even point up much higher than that. So our break-even is a couple dollars higher than where the stock is actually trading. And what this does is it gives us a little bit of breathing room for the stock actually to rally higher, right? Like I was saying before when we were looking at the chart, that it could go a little bit higher and still make money on this trade. But obviously, we definitely want the stock to continue lower from here, at least through October. That'll give us a good opportunity to make a couple $100 on this trade. Very small trade, keeping it small as always with these debit spreads. They're not always the highest probability of success trades, so we want to keep them small as far as position size. All right, so let's go over a bunch of the closing alerts that we had. I kind of paired up the UAL trades here and did a total calculation of our total profit and loss on all of these trades, so it's a little bit easier for you guys to see these. But with UAL, what happened today is that as soon as the stock opened, we got out when the stock was trading around 49. That ended up being a really good thing. It saved us from about another $300 of additional loss. But after all the adjustments that we made, we definitely pared down our loss. We could have lost about $180, $190 on this trade and took in some extra credit. So our loss, even though the stock moved completely against our original Iron Condor, was 118. So I feel good about this trade. It was a losing trade, but it is what it is. So we ended up closing out of the Condor and then also of the regular put that we were long for UAL as well. So that ended up being the trade that we made in UAL. For POT actually continued to move lower, but for some reason implied volatility has jumped for this calendar. Now, my intention was actually before today to let the September option that we are short, because with the calendar spread, we're short that front month option in September, we're long the back month. My intention was to leave that front month option, let it expire profitable, and keep this back month October option and this 37 call. But actually today it saw a pretty good increase in value to the point where we actually got out of the trade at a $15 credit. I don't really want to keep this trade on through October, so the fact that we got out today with a $15 credit and took a $10 loss on the entire position, all the contracts and everything, is pretty good. So I'm actually okay with that, even though POT was nowhere near 37 throughout the rest of the month. Had a nice little rally towards it at the end and could definitely possibly continue to move higher. Let me just get these studies out of the way here. But we could definitely see it move higher, but we needed it to be up around 37. And you can see in one day, we need it really centered up around 37 or so, and that's just not possible. So at this point, rather than lose the entire 15-cent credit on each of the 5 contracts that we have, it's better off just to close it out and take a small $10 loss. So very, very happy that we at least got out of that trade with pretty much nothing out of our pocket. All right, so WFC, this is Wells Fargo. Basically with WFC and PFE, which is Pfizer, both of these trades did exactly what we thought they would do. So both of these were call spreads for October. We anticipated that at some point the stock would rally and jump, and that's exactly what happened with both of them. So you can see that we sold both of these call spreads back that we originally bought. We bought them like debit spreads, like this, Tesla debit spread that we bought, except for the other side. So we think they were going higher. And we sold both of these back for nice profits, made about $100 on Wells Fargo and about $44 on Pfizer. Now, if you look at where the pricing is, and I just want to talk for a second about why we got rid of these trades and what kind of really gave us a signal to get out of them. There's nothing really with the stock that gave us a signal, but as far as the option price is concerned, you'll notice with Wells Fargo that the width of the strikes is $2.50, so from 50 to 52.5. That means that this spread can only go to $2.50, right? That's the most that you can sell it back for in the market. Well, we've had this trade on for, I think, about 2.5 weeks, and it's not worth, in my opinion, holding the trade for another month to make $50 when we've made, kind of the bulk of our profit on these trades. Now, remember, these are not high probability trades. These are kind of 50-50 bets just to keep us active. We keep the position size small. So the fact that we were shown a profit early is great. Got to take advantage of that by taking off the trade. Same thing with Pfizer. It's a $1 wide strike. So the most that this spread can go to as far as premium is $1, and it quickly went up to 74. So we've made almost 50% of our max gain in a few short weeks. There's no reason to hold this trade all the way through expiration for another 26 cents or so. It's just not a good use of our capital, especially since these from the start are not high probability trades to begin with. Now, Wells Fargo, you can see huge move off of the bottom. This is exactly what we wanted, exactly what we anticipated, but it actually is kind of shaping up to be a stock that we might end up going the other direction with and playing it to the short side, because we've got 1, 2, 3, 4, 5, 6, 7 days in a row that the stock is closed higher. And again, if we're trading long here, you got to take what the market gives you, right? I mean, the market gives you 7 days in a row of higher moves. You got to get out of the stock. Almost the exact same with Pfizer. A couple days straight in a row of moving higher. It definitely moved off the base. It made the move that we wanted it to make. Now let's not be greedy and see the market turn over by the end of October and turn this thing all the way into a losing position. It's just not exactly what we want to see happen. All right, so the other two trades that we closed out of today are two mega strangles on Apple and Yahoo. So both of these trades were wonderful trades. We entered them when implied volatility was very high, especially in Apple before it had its announcement of iPhone 6 and all that stuff. We went ahead and bought back both of these strangles, the October 110 call and 90 put for Apple, paid a debit of 53 cents. Made $174 on this trade. Really, at the end of the day, what it comes down to is the fact that this thing has contracted a lot already. Again, no point of going after another 53 cents for the next 36 days. It's just a lot of risk that you're taking on, especially with a naked position that has kind of undefined risk. Oh, excuse me, guys. I'm just stuffed up as well. And then the other trade that we got out of is Yahoo. We sold the 50 call for October and the 35 put. Again, kind of this mega strangle in Yahoo. And bought it back today for a 55-cent debit. We sold 3 of those originally, so we bought all 3 back, made $186 on this trade. You can see both of these were very good. With Yahoo, we actually had a little bit of movement in the stock, but actually not too much. I mean, it's continued to trade sideways. Implied volatility went down from 100 down to the 71st percentile, so it still remains pretty high. We can still kind of wait for a move here in Yahoo and enter some credit spreads or maybe an iron condor. But as far as this strangle is concerned, we definitely want to get this thing off the books because it was just taking up a lot of capital. With Apple, almost the exact same thing. The stock pretty much traded sideways after the announcement. It hasn't really made a huge move, but look at where implied volatility was. It was much, much higher than here. I think it was in the 70 or 80th percentile, and now it's down in the 26th percentile. So that contraction has just absolutely crushed the premium that's left in these options, and really kind of goes to show you that you shouldn't be buying strangles into these kind of one-off announcements, whether they're earnings or whatever the case is, because even though the stock made moves and it was up $5 or $6 in one direction, you still lost money on this trade just because of implied volatility if you were trading the other side of this. So a really, really good case study to show you, what kind of happens with these trades as implied volatility drops, these premiums decay, and that's a good opportunity for option sellers like us. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please let me know. Please share these videos. I don't ask it enough, but I know I get so many emails from people, which is so great. But what you can do to help us at Option Alpha spread the word about what we're trying to do here and trying to bring a little bit of clarity and financial literacy into the market is help spread the word by sharing these videos on Facebook, on YouTube, on Twitter, etc. As always, happy trading.